Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, June 13th, and then we'll see how things look for Wednesday, June 14th. We had another fairly strong update, not as powerful as what we've seen. We're still moving up higher. The market is quite overbought right now, both on a short-term basis and an intermediate-term basis, and now everything turns towards the Fed. The big debate right now, are they going to leave rates the same or are they going to raise them? You can make a case for either side. The evidence right now is suggesting that they will leave rates the same, and I'll show you the evidence to back that up. We're also dealing with a situation where the market is getting kind of out of control right now. You've got this FOMO going on, the fear of missing out, and people are just jumping in because they've missed what's already happened and they're afraid of getting left behind. And when those kinds of situations happen, which can last for a period of time, eventually that marks some kind of a top in the market. We turn and at least fall back. And then if we do, we'll start to reevaluate things on a day-by-day basis to see if the climate is shifting more negative. Before I get started, just a few things. I do have a supplemental video that I posted a little over a week ago. It talks about hedging and protection. If you find that that is a need that you have, see if this video will help you out. I do have a PDF that you can download to follow all the slides and charts. I also have a private Facebook group. There is a poll that is posted this week, and the question that I'm really wanting to know is, for those of you that watch the videos over the weekend, are you seeing a big difference in that recording versus what you're hearing right now? So far, the feedback is some say that it's the same. Some have even said that it's better. There are also videos posted on Rumble in case you can't find me on YouTube. So, at the open, what happened? We had a higher open. We went above R1 just right out of the gate at 43.51. We went up to R2 at 43.64. Then we stalled at 43.75. Not necessarily a big number in and of itself, other than it's a round number. There's probably some strike prices right at that level. We bumped up against that about 3 times before we fell back a little bit. Prices then fell back to R1, then we rebounded back up to 43.75 again. We chopped between 43.75 and R2, and then we closed above R2. We were up 0.69% on above average volume. So our technicals were positive, and we're breaking out. And we've got some more things that are happening showing that the overall market is improving, but we are overbought. We are overextended right now, and due for some kind of a pullback or at least a sideways move like we saw roughly a month ago, where the market was able to consolidate, not by going down, but by moving sideways. We'll have to see if something like that can happen now. The whole focus is inflation and interest rates. The Fed will be making their announcement at 2 p.m. Eastern. They'll be going off of what they say initially, and then there'll be the press conference after that, and they'll be hanging on every word that Jerome Powell says. So what are some comments that we can make? FOMO may signal a top. Now, this can go on for a while, so we want to be aware of that. This is the fear of missing out. The overall news coming out of the market, if you listen to a lot of people, including myself, was that we're looking more negative. Well, when we look at our charts, things were hanging in there fairly positive, but now you're seeing this real shift from negative over to positive. People want to get in. They don't want to miss out. A lot of times they're late to the party, and that signals some kind of a top, whether it's short-term, intermediate, or long-term. We don't really know that yet. We don't know how long this could continue either. Small caps were strong in Tuesday's session. Value did outperform growth on Tuesday. The ADX line is becoming extreme positive. That's our trend indicator, and we're starting to get pretty toppy there. Doesn't mean we have to stop here, but a lot of times when it gets this high, it means we've gone up pretty far, pretty fast. On a short-term basis, our list is getting longer. We have our short-term moving average study, the Stochc RSI, the Williams percent R, the CCI 14 and 20, all of our stochastics charts, the standard deviation. We're well into that third level now. The CMB composite index, the boom indicator, the RSI based on 9 periods, and we're even starting to see the 14 going in there. On an intermediate term basis, we have the McClellan oscillator based on the S&P, the Sean trend meter, the Erin indicator, the PMO study, the percent B, and as I mentioned, the RSI based on 14 periods. The dollar was down and interest rates were up. We're seeing some kind of weird action in the bond market right now. Maybe that chart that's kind of hard to figure out that I'll talk about later, That might be why we're not really making sense of what's going on right now. All of the yield curves that we've been watching remain inverted. What we're watching for are them to go back to being normal. Then that's when we start the countdown to see if we're going to, in fact, head into a recession. Sentiment is now extreme positive. We're getting a reading of 80, where we ticked up from 79. Our trend is positive and getting stronger. The ADX is above its moving average. They're above 20, but it's getting kind of high with that green line right now. And because of this other variable, we're positive overall. I could have easily switched the bias to positive, but we don't really know what's going to happen. This will produce some kind of a short-term gyration after the Fed makes their announcement and says a few things. What typically will happen, we'll have a little gyration at the open, then things will really settle down. A lot of times it has somewhat of an upward bias. Then they come out, make their announcement. Then the roller coaster ride starts. It goes in one direction. Then Chairperson Powell comes out with his press conference, and the market starts reacting to that. So it's kind of its own little beast in today's session. And I've also kept the momentum at mixed to positive. The economic reports that came out, we had the NFIB Small Business Optimism Survey. It actually improved a little bit to 89.4, where last time it was at 89. Here's the big one, and I don't have the other charts yet. It wasn't updated at shadowstats.com. As soon as I get those, I will include those in the video. But the headline number was that the CPI was up 0.1% on a month-over-month basis. That's lower than the 0.2% that they had expected. This is the headline number. This is what people are talking about. This is what is causing the market to really like this report. But when you look at the core CPI, when you take out food and energy, of course, the things you need, it came in as expected, up 0.4% on a month-over-month basis. Some areas that they're starting to pay more attention to inside of the report is that the shelter index was up 0.6%. Used car and truck sales were up 4.4%. And the total CPI, when you look at it on an annual basis, is up 4%. Last time it came in at 4.9%. That's quite a drop. That's what politicians like. But it's deeper inside of the report, which is really going to help determine what the Fed is going to do. The core CPI is still up 5.3% on a year-over-year basis. That's pretty high, but it did drop from the 5.5% we saw last time. Looking at some Isabel Net blog charts, where this first chart just says the stair step higher after a consolidation. This is the period that we were in, February, March, April, where the market was kind of chopping more or less sideways. If January is up over 5%, which it was, then we tend to see a pretty healthy move going into the end of the year. Doesn't mean it's going to go straight up. Doesn't mean that it's going to play out this way. We're just looking at what has typically happened from 1950 up to now. We look at the speculative positions in the S&P futures contracts. They have gone really bearish. What probably happened is we kept hitting the 4,200 level. We kept hitting that downward sloping trend channel, and it looked like, okay, we're going to turn and go down. There's no reason for the market to go up. And so you have a lot of this market that are heavily short right now, and that could give some real good support to the market. Now, these are non-commercial contracts. These are traders that are out there that are not necessarily the real knowledgeable folks doing this. So this tends to be more of the less educated crowd. And a lot of times when they're giving an extreme position, we want to look at the possibility of the opposite happening. Then looking at the Fed Fund futures curve, where we look at it now, that's the blue line where it's gone up a little bit. And then a week ago, the purple line, they actually had expected things to drop. The sentiment indicator, I don't use this chart all that much, but since it's turning positive and we're above zero, that's just showing that sentiment is really turning a lot more positive in the overall environment. Are you more likely to increase or decrease your exposure to equities in the coming days or weeks? That's really jumped up now to 51%. Then looking at the technical overbought sold composite, this is a little bit slower than some of the other overbought oversold indicators that we use, but we're at 81.3, above 80. This can still go up higher. It has in the past. We'll have to see. Are we going to stop where we're at and turn and go down, or will we continue higher? Then looking at the consolidated equity positioning, where they're getting above zero now. The market's been going up. People are getting in there. You're seeing the pressure on money managers who may have been more happy to sit on the sidelines. And they're like, wait a minute, the market's going up. I didn't think that was going to happen. I better jump in. And so they're exposing themselves a lot more to stocks. Then we look at CPI, and when it comes out, what kind of forecast for the annual inflation rate will it be based on what CPI comes out with? Well, we came in at 0.1%. So we're looking at about 3% overall. The Fed is trying to get down to their 2% target inflation rate. Then this is very similar to the intermarket analysis chart that I show every week, where on the top you have the S&P 500, which is blue, that's doing the best, followed by the lighter blue line, which is the equal weight index, and then the corporate bonds are this gold area, and then the purple area is oil, which has been under a lot of pressure right now. And then you have the commodity index, which is green. So a little different areas than what I cover. But going back to the beginning of the year, we're still seeing stocks performing quite well. Then we look at market breadth and how it's narrowed. It's been the most since the tech bubble. That was in the year 2000. It's really coming down overall. It's the percent below the 52-week high. The S&P index less the median stock price, we're dropping below this -1 standard deviation, just showing that there's not a lot of participation in the market moving up. Keeping an eye on the Fed. This will be the last reading that we get before they actually make their announcement. As of Tuesday's close, there's an 89.6% chance that the Fed is going to leave rates the same. Now, the Fed should do what the market tells it to do, but it doesn't always work out that way. So there could be kind of a curveball that's thrown out there or some statements that are made. Right now, it's the idea that they're going to skip this meeting, not necessarily pause, but the idea is if inflation starts to really reignite, that further down the road, they will continue to raise interest rates. And this is how it's changed. We're now looking at the most likelihood of them keeping rates the same, and that's higher than it's been looking back 1 day, 1 week, and 1 month. The camp that thinks that we're going to raise them 25 basis points, that is now really starting to drop off. Economic reports. Here's CPI. Please feel free to pause this. I just went to Wikipedia to get this information over here, but it's showing the rate of change over 12 months where it is declining. Here's the seasonally adjusted figure itself up on the top. What we pay attention to is on the bottom. The 12-month change, which is annual, and then the month-over-month change, and it is showing a decline. Then we look at the core CPI, and this is what the Fed really pays attention to. It's also going up overall, but has been declining over the last year and actually saw a little bit of a tick up from month over month. Edward Yardeni had an interesting post. Every week he puts out the Investors Intelligence Survey. This actually comes from another source, just showing that we're getting a lot more positive. Now, this information is about a week old now. After being extreme negative, they are showing some improvement, but not necessarily an extreme reading. Then in his email, and I'm just going to go through what he quoted, he said stock prices rallied from the open today on May's CPI report. It wasn't surprisingly good, but investors and traders feared that it might be surprisingly bad. That's been the modus operandi of this bull market since October 12th of 2022. It's been rallying on all the bad things that aren't happening. So far, there's been no recession, no earnings collapse, no run on the banks, no debt ceiling disaster, and maybe no Fed rate hike tomorrow. Any day when bad things don't happen is a good day for stocks. Fears that narrow the rally led by the Mega Cap 8 might be a classic setup for a fall eased in recent days as the rally seems to be broadening to financials, industrials, and materials. And that's a pretty astute evaluation of what's going on right now. You've got a lot of doom and gloomers out there. You've got a lot of folks that are seeing this resistance, that resistance, overbought this, oversold that, and all these different dynamics going on, just sure that we are going to turn and go down. And that could happen. But we also have to look at our charts. What are they telling us right now? What will they tell us tomorrow? And then day by day by day, we reevaluate the situation. All right, let's get into our charts. Here's the intraday chart. We did gap higher above R1, immediately went up to R2, fell back a little bit, and then we're able to break above R2, which now became support, at least for the early part of the day. We started to break higher, and we hit this 43.75 level roughly 3 times, maybe even 4 if you want to count that. Then, as I was watching this, I thought, okay, here we go. We're going to really start going down. Nope, it didn't fall all that far. We were able to get back above this moving average and close fairly near the high above R2. Here's the 10-minute intraday chart of the SPY, where the initial overnight session was pretty much flat. Then we saw things start to show a little bit of movement in the pre-market session, and currently we're pretty much going sideways right now. There's a lot of wait and see what's going to happen. Then growth in value. They're still performing about the same right now, But on a closing basis, growth underperformed value. Also for the mid caps, it underperformed, and they were about even with the small caps, where the core for the small caps, which is the ETF, SLY, that was actually down. Looking at the growth to value 10-minute intraday chart, where we actually closed down a little bit when you compare growth with value, that means that growth underperformed. Looking at sentiment, still not suggesting there's any fear in the market with our Ulcer Index. The VIX ticked down just slightly on the line chart as well as the bar chart. The VIX of the VIX actually ticked down slightly. And the equity put call ratio continues to fall as the market's going up. We're watching this too. This is the 253 period simple moving average. It is rolling over and continuing to go down. We're not going to really know for some time if this is legitimate. That's why we're watching it. And then looking at the MOVE Index, which measures bond volatility, this is not really showing that there's much fear right now. It did spike up a little bit, even though bonds were down on the day, where the VIX is showing almost no fear at all. This other area in here, I take the VIX and I subtract the MOVE Index to get the green line. And then the red line is the S&P, just to kind of get an idea of how they're moving together. The SKU index is still giving us an extreme reading, and it's not really a surprise. We have the Fed making their announcement. Now, how this differs from the VIX is the VIX looks at the money options, where the SKU index looks at out of the money options, and they're expecting some kind of a big move. If you look at other times when we were giving an extreme reading, sometimes the market kept going up, sometimes it marked a bottom, sometimes it marked a top. So we'll just have to see how this plays out. Our other fear gauge that we look at is continuing to decline, as well as the other fear gauge. And we're still maintaining a risk-on posture where the ratio is going up. Our advanced decline line studies, we're showing some real improvement based on price and even more improvement still based on volume. If we can break out, which we've already done based on volume, and can we break out above previous highs based on price, it might negate this negative divergence that we've been seeing. This is also encouraging. As we were going higher, the new highs finally broke out. So that is positive. We're turning up with the 5 period and going higher as well as with the 10 period. We're above the zero line with our advanced decline ratio. Accumulation distribution is also positive. We're seeing some improvement with the cumulative advanced decline line as well as the regular advanced decline line. And we're still above this trend line with the other advanced decline line of the NYSE that we follow. We're also seeing some improvement based on price with common stock as well as volume. Not enough to really get rid of this negative divergence yet, but it is showing improvement. The NYSE advanced decline line did show some more improvement. The S&P was up, the mid caps were up, and the small caps were up. So this was more broad participation. Looking at our trend and volume analysis, here's the ADX. Where we are getting a little bit toppy here. We're above 40 with the green line. Doesn't mean we have to stop here, but other times we didn't even get this high before that could often mark some kind of a top in the market, or at least that we might slow down. Then our short-term ADX is also getting pretty extreme positive, but still looking good overall. Volume picked up a little bit, but overall we have been declining. Our short-term analysis, we're breaking above the August high. We're still above that. We closed above that. Down below, you see where volume was above average. We're getting a little toppy with our 20-period exponential moving average. Again, it could still go higher. We're still looking good with the 50 and the 200. So short-term, this is a little bit overbought. The Stochk RSI is overbought, as is the Williams percent R. The CCI 14 and 20 all are extreme positive. Looking at our stochastics, short, intermediate, and long-term, extreme positive. Now, I have to explain this from time to time. This is a further subdivision of the short-term time frame, which I define as days to weeks. This means short-term, and then intermediate short-term, and long short-term, and we're overextended in all three of those divisions of the short-term time frame. CMB Composite Index, also looking extreme. The boom indicator, based on a 20-period moving average, meaning how far away are we from the moving average, starting to go extreme again. We saw this a few days ago where it went extreme, came back down, now it's back up. Getting a little close to being extreme based on the 50-period moving average. Longer term, we are showing some improvement and we're above zero. The force index continues to be positive. Intermediate term charts. Here's the balance of power above the dashed line and advancing. The go-no-go system with the darker blue is positive. TTM squeeze, also positive. Here's where we're getting actually above the third standard deviation on this chart, meaning we've gone up pretty far, pretty fast. The Bollinger Band's also getting a little bit to the outside of the upper Bollinger Band, and we measure that by the percent B indicator. It could still go higher, but it's starting to look extreme. The PPO, which measures momentum, still positive in the long intermediate term, and we're turning back up in the short term. The Erin indicator, after giving us an extreme positive reading, has declined slightly. The S&P McClellan oscillator also starting to get into extreme positive territory. The NYSE McClellan oscillator, which is a broader measure, it is showing some improvement. The summation index based on price is turning up, and with volume, we broke above this downward sloping trend line based on volume. We still have a ways to go based on price. Then a broader look at the summation index showing some improvement overall, but still lagging with the NYSE summation index. The Swenlin trading oscillator has turned back up based on price and volume. The PMO, a momentum study, is continuing to advance and also looking good based on price and volume. Starting to get extreme with the percent of PMOs that are rising, looking better with the buy signals. Any more follow through, we could go extreme, and we're going up with the PMOs that are above zero. The Elder Impulse system for the S&P remains at positive, and we do have a little gap in here now that might get dealt with at some point. The Parabolic SAR system is also positive with the dots underneath. The slope is going higher, and the MACD is going higher. Looking at all of our oscillators, they are all trending higher. The Sean Trend Meter is back to extreme positive. BPI for the S&P 500 is showing improvement, but we're still not really breaking out of this negative divergence. The NYSE Bullish Percent Index continues to improve. We're above 50 and advancing, but still lagging behind. The Chaikin Money Flow continues to be positive. The Chaikin Oscillator is also positive. The money flow is positive. The Ultimate Oscillator ticked down just a little bit. And the Vortex continues to be positive, and we still could go a little bit higher with this green line, but sometimes when it goes up like this, can often mark some kind of a top. The RSI 14 is starting to get extreme positive, where the RSI 9 has already gone extreme positive. On balance volume is also positive, and I've got both charts to show you this. We're seeing some improvement with the percent of stocks in the S&P above their 200-day moving average. It's breaking out of this downward sloping trend line. Based on the 50-period moving average, we are breaking out, but we still need to see some more follow-through for this to look a lot better. Then here's another look at that same chart, just color coding it a little bit different, where it shows us breaking out with the 200 and also breaking out a little bit with the 50-period. The Copic Curve and the Pring Bottom Fisher are still generating buy signals. Our Fibonacci studies, we're still above this 75% quadrant level, and we've also been able to break out above this other resistance at the August high. We're above the 100% retracement level on our short-term fib chart, which goes back to the August high. Longer term, we're above the 61.8% level. And then longer term, we're also breaking out above this Fibonacci level with other areas of resistance. But on a Fibonacci basis, we would have to go back to the all-time high. We're still above this downward sloping trend channel, and the longer we stay above that, the more positive it is. And that's what a lot of folks were using to really justify that the market was going to turn and go down. But it just hasn't worked out that way. Our different charts are all positive. The Heiken Ashi, the Kegi, the Renko, the three-line breaker, all positive. We had a new X drawn on the point and figure chart. The signal that was generated back on May 18th, which that's when Mount St. Helens blew in 1980. But this year, it's signaling a double top breakout. Two volcanoes are erupting. Looking at the different indexes, the equal weight is showing some improvement, but still underperforming. We're seeing this ratio going pretty much sideways right now when you compare the S&P to the equal weight S&P. We're still seeing a longer-term negative divergence, but the transports might be breaking out if we can get above this line. Shorter term, we're seeing weakness in the utilities. The transports are continuing to underperform the Dow. Our new take on Dow theory shows us breaking out with the S&P and really breaking out with the NASDAQ, so this is a positive divergence. You could change that to another way of saying this is a convergence. The Dow is continuing to show some strength. The diamonds remain positive. The NASDAQ also broke above this R1 level and is breaking above this 50% retracement level. We still have some overhead resistance at this 61.8 level. But inside of the NASDAQ, we're still seeing the cumulative new highs minus the new lows dropping. However, on the bottom, the raw score is still above zero. NASDAQ 100 also closed just barely above the R1 level, and the Elder Impulse system remains positive. But we're not seeing a real broad participation with the BPI. It's positive and going up and not giving us a real extreme reading, again suggesting that there's not as many stocks participating. We're above the 61.8% retracement level with the NASDAQ 100. The next area could be going back to the late March highs in 2022. If we break above that at some point in the future, now we're looking at possibly testing the all-time high. Small cap index showing a lot of improvements, still above this R2 level, was up almost 1%. And we're seeing now where we were able to get above this resistance area. When we were coming down, that acted as support. When we broke through it, we found support down here. As we're coming back up, we were able to close back above that. The RSI is starting to look extreme, and the MACD is also continuing to be positive. Small caps continue to underperform the S&P overall. We want to see that reverse if we're going to get a lot more positive. The small caps for the Elder Impulse system has now switched to neutral. And here we're looking at this, and I've tried to add some moving averages here where the small cap index has really been under a lot of pressure. Now it's starting to go back up. While this was going down, we saw growth really outperforming value. Now that this is starting to go back up, we're seeing a little bit of weakness with growth compared to value, but it's still in an overall uptrend. The mid caps also were able to stay above this R2 level. We have switched to positive for the Elder Impulse system for the mid caps, and the mid caps also under a lot of pressure, starting to go back up. And this is where we're seeing more strength between growth and value. The FANG index, thought I would bring this up. It's in an overall uptrend. That's where the real honeys are right now. And longer term, if you go all the way back to the all-time high, which is just a little bit over 8,000, are we going to try to give a run to that? Maybe not right now, but if things still continue in the same basic way that they have, we might really give a challenge to that. ARK is also looking more positive. I thought I'd never say that again. We're actually showing a golden cross here, and ARK has been performing better. Robotics, AI, ETF, also really positive, but it's still not really outperforming the tech sector. The broad market of the S&P 1500 is really outperforming the shorter-term bonds, and the broad market is also outperforming longer-term bonds, meaning 3 to 7 years. The tech sector is really outperforming just about everything right now, including 3 to 7 year bonds. The S&P is also suggesting that we might see a soft landing when you compare it to bond prices. And this is an inverse of that same chart showing how bonds are underperforming. Then, just to keep this in the mix, the home construction ETF is really outperforming bonds. If the market was getting ready to fall off a cliff, would this really be going up? On one hand, you could say, oh, these are just idiots. They don't know what they're talking about. They're just a bunch of fools. Or at the same time, you have some very knowledgeable people that really do know what's going on, and they are the ones who are tending to drive this a little bit higher. Giving another look at growth versus value, showing how growth is outperforming, and this is showing how value is underperforming. Keeping an eye on the financial sector, still in an overall downtrend. This would be another area to see some real improvement that could help the overall market. Because if we look back longer term to 2007, this is a pretty significant area of support. It had been resistance. We broke through that. Now it is becoming support. Can that show some improvement? Then looking at the financial sector to the S&P, it continues to underperform. And the regional banking ETF is also underperforming the financial sector. Looking at bonds, where we were up with the 10-year yield and down with the 10-year price. Then this is the chart that's producing some confusion. The longer-term correlation continues to weaken. The shorter-term correlation is also weakening. As this is happening, we see the S&P going up and the long-term bond going down. So this spread is really starting to widen. Then on the bottom, I just have the inverse of that same spread. But on a more positive front, folks are getting into the riskier bonds more than they are the more conservative bonds. And then when we look at the 1 to 3 month T-bill, which is pretty much cash compared to further out bonds, this is the concerning chart. We were going down overall, but now we're starting to go back up. That means there's uncertainty about what's going on. Then we look at the 1 to 3 year bond and compare it with further out. This is starting to go back up. The uptrend suggests that the Fed was raising rates, which is exactly what happened. We want to see this starting to come back down for it to turn more positive. When the market is fairly convinced that the Fed is done raising interest rates, that's when we'll also see this ratio begin to fall. Then looking at just an inverse of that as well, it said if the Fed has finished raising rates, this chart would be going up. It's going down. This suggests that the markets are not completely confident that the Fed is finished. Then we're also keeping an eye on this. The 3-month yield is above where it was at if you go back to 2007, right before the great financial crisis. Is this some kind of a warning sign? Our long-term analysis, this is positive. We're looking like we're breaking above this line with the special K. This is a long-term signal. When we dropped below it in early 2022, that's when we ran into our mess. We tried to get above it a couple times before, but we're unable to do that. It's going to take a while for us to really determine if this is an actual crossover, because this is a slow momentum oscillator. Longer term, our 150 and 200-day simple moving average study is showing improvement. I have the 50 period on top, mainly just for reference. An update of our possible positive scenarios. We're seeing things improve based on price, where we're above zero. When we look at the 19-day exponential moving average of the advanced decline ratio, we're starting to get a little toppy now based on volume. So that's something to be aware of. But when we look at our ratios, the Qs are back to outperforming the S&P. Discretionary is outperforming the S&P. Large cap growth is outperforming large cap value. Our other growth to value ratios, looking good with the large caps, improving with the mid caps, kind of showing a little improvement with the small caps. The S&P to utilities ratio continues to go up overall. This could give some good support to the S&P. And we're above zero when we look at the broad range of our 5-period moving average of the highs minus the lows. Longer term, we have our 50-period exponential moving average of the new highs minus the new lows. It's turning back up because the black line, which is the indicator, continues to be positive. And then looking at the S&P 500 growth versus value, it has been showing some weakness and is actually starting to go back down. That's a bit of a warning sign, but we're still in an overall uptrend. Then here's a newer chart showing the discretionary equal weight, which is going up, compared to the equal weight of the staples, which has been under pressure. When you take a ratio between the two, this shows that discretionary is outperforming staples. That's more growth versus value in a smaller sense. Then looking at the staples, the S&P 500, this is also positive. This ratio continues to fall as the S&P is now starting to break out. So what's our outlook for Wednesday? We still are dealing with earnings season. At least they're few and far between now. We do have quadruple witching coming up at the latter part of this week. The Fed will make a rate decision on Wednesday. That's what we're waiting for. The European central banks will be on Thursday. The Bank of Japan will be on Friday. And then next week, the Bank of England will make their announcement. The technicals are positive, but we are now overbought in the short and intermediate term. The negatives and negative divergences that we've been seeing are showing some improvement. We have the weekly MBA mortgage index, so it'll be coming out. We have the PPI, and then we have the rate decision, which will be at 2 p.m. Eastern time. And then the Fed is pretty much what the market is focused on right now. Here's the economic calendar showing what's coming up for Wednesday. We have retail sales and industrial production coming out on Thursday, and then consumer sentiment on Friday. We have one speech that will be given on Friday in Norway. Unless you plan on visiting that, a lot of people won't be watching it. Here's the Stock Traders Almanac statistics for June 14th. We're neutral to positive with the Dow and S&P, where we're more positive with the NASDAQ. We're on the 10th trading day of the month, showing the green dashed line is somewhat pointing up. Then if you're following the NASDAQ, it tends to do well until the middle part of July. So our scenarios can't really go with the down one. We're looking more at the up one, but we are overbought right now, and it would be kind of risky, especially taking a position ahead of what the Fed does, because it's pretty much a roll of the dice is how the market's going to react to that. And we're not going with a sideways trend now because both of our ADX charts, the short and then the regular one, are trending. What are the warning signs that we're keeping an eye on? We're very overbought in the short and intermediate term. And by vary, I mean it could change at any time. We could still get further overbought than where we're at right now. The BPIs are still diverging in a negative way, but the BPI for the S&P is showing improvement. We've got a lot of these negative divergences and signs of weakness, but the overall tendency is for some of them to show some improvement. The VIX is still showing that there's no fear. The cumulative new highs and new lows on the NASDAQ, they still continue to go down. The 3-month yield is above its pre-Great Financial Crisis level. Small caps generated a recent death cross and have seen recent strength, though. And earnings season continues, but it's kind of getting a little more sparse now. The positive signs, we do have seasonality and setups that remain in the background. The new highs and new lows are really expanding for the S&P. That is encouraging. The long-term special K indicator is turning positive. And the long-term equity put-call ratio, the 253-day moving average, it may be turning positive, but we kind of have to wait on that one. The Copic curve and the Pring bottom fisher are generating buy signals. The S&P still remains above that downtrend channel upper line. We're still in a risk-on posture. Lower price levels may provide support if we start to really move to the downside, which could be a fib level, it could be a moving average, or another level on a different index. The S&P continues to outperform utilities. The NASDAQ and NASDAQ 100 are continuing to break out. The staples are also really underperforming the S&P, which could give good support to the S&P. The mid-caps have generated a golden cross now. After just generating a death cross not so long ago, small and mid-cap growth is showing strength, but some recent weakness. So our conclusion, the S&P is positive. We've got some negative things to worry about, but short and intermediate term, we are overbought. Short term positive, but overbought. Intermediate term positive, but overbought. Long term, we continue to be positive. Thank you. I hope you found this helpful. I hope you have a good day. I'll be watching what the Fed's going to do along with everybody else, and then we'll come back tomorrow and try to reevaluate things. So have a great day, and I'll talk to you in the next video.